In this presentation, we will work an example problem related to the consumption method for tracking and recording supplies inventory for a modified accrual accounting method for a fund accounting method, this being for the general fund. When considering the tracking of supplies inventory for the modified accrual accounting for the general fund, we typically have two methods that we can use. We have the consumption method, the purchases method. We're going to be concentrating here on the consumption method. When we compare and contrast this to normal type of tracking within supplies on an accrual basis, we typically think of the accrual basis as having an adjusting entry at the end of the time period. It'll be slightly different here. We'll compare and contrast these methods to a normal type of accrual accounting as we think about the government-wide type of activity, which will be recording the supplies inventory more on an accrual type basis as opposed to the fund accounts, such as the general fund, which will be recording on the modified accrual basis. We here modified accrual consumption method as opposed to the purchases method. This is going to be our information. We're going to go through 2 years so we can see how this will cross over and be rolled out into what would be the equity type funds or the net balance type of funds, net asset type funds, and then see what would happen in the following year. We here then in year 1. We're going to have the trial balance. Trial balance has assets in green, liabilities in orange, then what would be the equity or the fund balance, net assets, light blue, and then what would be the expense accounts and income statement accounts in the dark blue. We have down here also some accounts related to the estimated revenues and expenditures. We're going to be concentrating on the actual more income statement type accounts, revenue and expenditures as we consider the supplies, tracking the supplies inventory. First item, we've got supplies ordered at estimated costs, so at this estimated cost. Now within the fund accounting, we're going to say they're ordered kind of like we sent a purchase order, but we haven't received the inventory, we haven't paid for the inventory. Normally we wouldn't record the purchase order for a for-profit type of normal accrual accounting. Here we're going to record this. This is going to be recorded in the encumbrances. So we're going to say encumbrances, not an expense account, but a holding account until the expense account will be recognized. The credit then go into what would be an equity type account or similar to an equity type account, net asset type of account, which will be the encumbrances outstanding. So recording this, we're going to increase the encumbrances. Again, not a budgetary account, not an expense or income statement account, but a holding account, which will then be reversed exactly as we record the expense when the expense should be triggered under the modified accrual method. And then we have the other side going to the equity type account with a net asset type of account. These will always be equal and opposite. We'll reverse them once we receive the inventory related to it. And then the next item, we're going to say that the supplies received and actual cost was paid. So we're going to say that this whole amount, the encumbered amount, has now been received, at which point we can record it under normal kind of accrual type of accounting and under this modified accrual as rather than an expense and expenditure here. And we then need to reverse the encumbrance and record the expense. So at this point, we're going to reverse the entire encumbrance. This would be the normal type of process. We're going to say, all right, now we reverse the encumbrance, just taking off the books what exactly we did last time, because now we're saying that we have received this information. We need to move it, in essence, from encumbrances into the expense item. We need to first completely reverse what we did last time, bringing these amounts back to zero. We are going to debit the encumbrance outstanding. It has a credit. We'll debit it, making it go down. And then the encumbrances has a debit. We credit it, making it go back down. Then we can actually record the transaction at the actual cost as opposed to the estimated cost with the encumbrances when we sent out the order. And now we're going to record what would normally be thought of as normal type of accrual accounting related entry. We're going to debit the inventory supplies this time, an asset account. So we're tracking it as an asset, and then we're going to count it at the end of the time period. This is what we would expect for inventory, to track inventory, put it on the books as an asset, count it at the end of the time period, periodic inventory system, and then reduce it, recording the expense at that point in time, at the point in time of the physical count, and paying either cash or the payable at that point in time. So this would be more of a normal type of transaction. Notice where we did not put it, we didn't put it into the expenditure. We're doing what would be kind of more expected on normal accrual accounting. We put it into the inventory, increasing inventory. And inventory, similar to supplies inventory, similar to cost of goods sold or normal type of inventory, is usually calculated beginning balance plus the purchases. That's the amount available minus the ending balance, which we would have for the physical count, gives us the amount that we consumed during the time period. So inventory is going up, and then the cash is what we paid, cash then going down. Next transaction, we're going to say that there's supplies remaining at the end of the time period, 77,100. And now what we're going to do, this would be what we would think of as an adjusting entry normally for accrual accounting. It's going to be slightly different than the adjusting entry here. We're going to take this supplies account, we're going to mark it down to the physical count. We assume then that that's going to be the amount that we used. So we then expense that item. And so the first component of this transaction will look much the same. We're going to say, all right, if this would be an adjusting type of entry, this is what we have in the books. We had 0 at the beginning plus purchases 851,500. That's what we have available for sale. Then we're going to count the inventory at the end of the time period minus the ending inventory, which we counted to be 77,100. That means the difference is going to be 774,400. That's what we need to take this amount down by in order to get to the physical count 77,100. So that's going to be our transaction. We're going to say the expenditures, we consumed them. Expenses is going to be the account we used instead of expenses, expenditures being used for the modified accrual. That makes sense. We're going to credit the inventory of supplies. This looks like our normal type of adjusting entries for an accrual type of account, bringing the inventory down with a credit to the physical count, and then recording the expenses, increasing the expense for the amount that was consumed at this point in time, this being this amount then being recorded on an accrual basis rather than a cash basis, because you'll note that we actually paid the entire amount, the 851,500. We're recording the amount that was consumed on an accrual type of basis. Now the next step is going to be the unusual item. We have to tack on or add another journal entry, and that journal entry is simply going to be a debit to the fund balance unassigned and a credit to fund balance non-spendable. So why would we do this? Why do we need this entry? It looks like we've already done everything we need to do. This entry only has to do with those accounts that are in what would be kind of the equity section. So it's the assets minus the liability, the net assets, the fund balance type of section. We're taking it out of one fund balance type of account, putting it into another fund balance type of account. Why do we need to do that? Well, what we're trying to do here, remember for the governmental accounting, we're trying to be really transparent. And we know that these are going to be basically short-term kind of activities that are happening in the general fund. And we know that assets minus liabilities is going to equal the equity section. So obviously in our case with this small problem, we could see that clearly the asset of cash plus the supplies minus the liability is going to be the 168.6, which adds up to the 943,000 minus the 774,400 that we're going to close out to equity. So assets minus liabilities equals what would be equivalent to equity or fund balance. And we would think that in governmental accounting, we say, oh, we have that much in fund balance, we can then use that in the future. And we want to make clear that no, we can't use that in the future because this amount of the equity, the 77, has already been spent and represents supplies that are on the books. So that's one reason that we're just basically breaking it out from one fund balance to another, saying, hey, this is non-spendable stuff here. Don't touch that stuff because it's already been spent. So when you look at the net balance, the fund balance, don't consider that as something as spendable. So that's going to be the new type of thing. We're going to basically just take it out of the fund balance unassigned with a debit, removing it from there, putting it into the fund balance non-spendable with the credit. And of course, the fund balance non-spendable represents the equity portion of the inventory that is not, can't be spent, already has been spent. And then if we do the closing entry, we're going to say, all right, now we'll do the closing entry, closing out the income statement accounts. We only have one of them in our small problem. We would close out the expenditures to the equity section. So this has a debit balance in it. We need to close it out. We're going to do the opposite thing to it, a credit. So we're going to credit the expenditure. We're going to put it into the equity, or what would be the equity, the fund balance section, assets minus liability type section. We're going to put that into the unassigned section. So the transaction looks like this. We're going to close out the books. And this is our post-closing trial balance now, having a 0 in the income statement accounts, putting that amount into the what would be the equity or fund balance type section. We put it into the unassigned. Now we have the assets minus the liabilities equals the fund balance, but we're clearly stating that This is going to be the unassigned fund balance. These have already been spent and they represent the inventory part of the asset. So we can't basically do anything with that item. We want to make that clear by breaking it out in the fund balances. Let's go to year 2. This would be our starting number in year 2. This is our post-closing trial balance for year 1. Starting numbers for year 2. We'll go through the same kind of transactions. First, we have the amount of supplies ordered. So once again, we haven't received the supplies. This is like sending out the purchase order, and we haven't paid for them. Therefore, wouldn't be any transaction for accrual accounting. However, here we're going to use that encumbrances account, debiting encumbrances, crediting encumbrances outstanding. So this is kind of that unusual step type of account. We can't record the expenditure yet, but we want to put it on the books saying that we have basically applied these out, and therefore we're going to record this account encumbrances and put the other side into the equity account encumbrances outstanding, or the equity type account, the fund balance type account, as a holding account until the point in time that we have received the inventory and therefore can record the expenditure. Next item, we're going to say that we got the inventory, and this is going to be the actual amount versus the estimated amount, but we received all of the inventory related to the estimate that we had made, therefore reverse the estimate entirely. So this is what's on the books for the encumbrances. It's a debit. We're going to do the opposite thing to it, credit it to make it go down to 0. So we're going to credit the encumbrances, debit the encumbrances outstanding. So there we have that. Here's the beginning balance. Here's the credit. Here's us bringing it to 0. Here's the encumbrances outstanding credit. We debit it, bringing it down to 0. And now we can record the related expenditures, not at the estimated amount, but at the actual amount. So we're going to record the expenses related to it now that we've received them at the actual amount. And so that's going to be what we would normally kind of see or think, rather than the expenditure. And I might have mentioned expenditure last time. We're not going to record it as an expenditure under the consumption method. We're going to record it as we would under normal accrual accounting as an asset rather than an expense. And then we'll count it at the end of the year, and we'll record it as an expense as we consume it. So we debit the asset. So the asset's going to go up. Note that the cash is overdrawn, so don't let that throw you off in the example problem. And we're going to increase it here, and the other side is going to go to cash because we're going to say that we paid cash at that point in time. So, and remember, as we go through this, notice that when I keep saying the encumbrance account is holding it until the expense is triggered. In this case, of course, it's the same concept. The expense is kind of triggered, but we're not recording the expense in this case. We're recording the asset. We got the asset. We're recording the asset as we typically would under accrual accounting, and then we'll record the expense at the end of the time period with an adjusting entry, periodic kind of accounting system, beginning balances plus purchases minus ending balances. So that's what we'll do next time. We're going to say, all right, now this is how much is left, 60,000 left. So now we do the adjusting entry that we would expect, and we're going to say, all right, well, this is how much is in there, 9,535,500, and we're going to say that 60,000 is left minus, so we're going to say that we have consumed 893,500. So therefore, we're going to debit the expenditure 893.5, credit inventory 893.5. That brings inventory down with the credit to the 60,000 matching the physical count, and then we have the expenditures going up by the amount that we consumed on an accrual basis, the 893,500. That amount represents the amount we consumed, not the amount we paid, because remember we paid cash basis the 876,400. And then we have the funny thing that happens, because now these two accounts don't match each other, right? This doesn't match this, and we need those two to match because this account represents the amount of the net assets minus liabilities that is being applied to or has already been consumed. And therefore, we need to make the adjustment 17,100 because that's the 70,100 minus the 60,000. That's what we need in order for this number to match what's in the inventory. So we got to say, all right, here's the equity section. I need that to be equivalent to the amount that has already been spent and is on the inventory. So I'm going to say that's a credit. I need to debit it by 17,700. Taking it out of non-spendable, putting it into unassigned. If we then do so, now we're going to reduce this amount to 60,000. That then matches the inventory showing the net value that now should not be used. And then the other side is then going to the unassigned balance. So then if we do our closing entry, we'll get our post-closing trial balance. We only have one item happening in our simple problem. We only have the expenditure. We're going to close out the expenditure to the equity section now. So we're going to say that this is a debit. We're going to credit it to make it go down. We're going to debit the unassigned area. So this goes from here down to 0. And then we have the unassigned, which is going to be a debit here. Sorry, this is a debit. We credited it, making it go down to 0. This is a credit. We debit it, making it go to the 740.84.900. Now we have assets minus liabilities equals equity, or the equivalent of equity, the fund balance, but the fund balance now being broken out so that we can clearly see the amount that is non-spendable. Why? Because it represents the assets that have already been applied or already spent and are on the books as an asset of inventory supplies.